Christian Munafo from Liberty Street Advisors. Welcome to the Alternative Symposium.
Great to be here.
Can you expand on the asset class that is late-stage venture capital?
Sure. So the easiest way to think about late-stage venture capital is it falls in between what we would call early-stage venture. So think about that as people trying to essentially conceptualize an idea, whiteboarding something. And on the other side, you have buyout stage assets, which are typically more mature, more profitable type businesses, slower growth. Late-stage venture kind of falls in the middle. So you typically have technology companies that are growing at hyper rates. They may not yet be entirely profitable because they're focused on disrupting industries. So that's essentially what late-stage venture. It's a combination of kind of growth and innovation.
And how big is that universe, and is it growing?
It's a massive universe, yeah, primarily because of the dynamics that we've seen over the past couple of decades where you have these companies just staying private for longer and growing into larger and larger businesses. There's been well over $1 trillion invested in this asset class over the last 10 years alone, and hundreds of billions of dry powder sitting on the sidelines. So it's a very large addressable market.
And how's the sector evolved as we get further into 2023?
2023, we've had an interesting, development actually starting last year in probably Q2, where the shift in sentiment essentially resulted in a lot of investors who had been piling in to this market, chasing alpha, have essentially gone away. So these are investors who are typically non-traditional investors that are arguably over-allocating to the space. So think sovereign wealth, crossover funds, hedge funds, family offices. So the real focus in 2023 is now those firms continuing to just move away or at least massively reduce their allocations, while the traditional investors are now kind of going back in and taking advantage of the price dislocations resulting from that. So it's actually a really exciting time for capital deployment. Not without challenges, but it's a really good time for capital deployment.
Are the type of sectors similar to traditional venture capital, as in software and technology, or is it more broad?
Yeah, technology and innovation essentially touches all sectors of the economy. So we basically, in our U.S. fund, which we're building now for the GAM LSA partnership, has 20 underlying sectors that it's represented by, ranging anywhere from the space economy to cybersecurity, financial technology, digital health, supply chain, agricultural food technology. So it pretty much encapsulates the entire economy.
And where are you seeing the greatest opportunities within those sectors?
So, cybersecurity continues to be a really robust area. Areas of financial technology, digital health. Supply chain seems to have mostly gotten back in order, but there are still opportunities there to really take advantage of disruptions that have resulted. And then artificial intelligence and machine learning are the buzzwords right now, but those have been around and are embedded inside of sector-based technology for a very long period of time. But using that AI and machine learning for increased efficiency and better yield is something we're definitely going to continue to see. So we think there's opportunities across the market, but those are ones I'd say we're most interested about.
And how important is the IPO market for realizations? And has this changed in recent years?
Well, it's absolutely changed, especially over the last 12 months. It's almost, for all intents and purposes, been closed. Historically, venture-backed companies, only about 2/3 of them go through M&A, 1/3 goes through public market offerings. So it's not to say the public markets are not important. They are very important, but it tends not to be the only avenue for these types of companies to get liquid. So essentially you have a market right now where these companies will continue staying private for longer until the opportune time presents itself for them to exit, whether that's through an M&A event, whether it's through an IPO event. But the more robust the public markets are, the more options for liquidity the underlying asset class has. So we like to see public markets open. If they're shut for a little while, not a big deal. We're long-term investors.
Do you see similarities between this cycle and prior cycles?
Yeah, there's a lot of similarities. You have, a lot of underlying companies that got arguably overcapitalized, that were burning at unrealistic rates. They really weren't ultimately that differentiated. They were, really kind of like copycat type companies. You have a lot of that, like we saw in the tech bubble age. You have a lot of that in the past, I would say, 5 years. And so as a result of that, now you're seeing the market correct itself. You're seeing valuations come down. You're seeing the bifurcation of what really are good companies versus what really are not very good companies. And companies are being forced to get lean and do essentially more with less in terms of their capital expenditures. And so, overall, it's arguably not that much different. There's always differences, but in the aggregate, it's not that much different from prior cycles.
And what impact are rising interest rates having on valuations or the cost of capital?
So in the venture world, these companies rarely have any debt because, frankly, they don't deserve it, right? These are not companies that are frequently printing cash. So the interest rates doesn't have a direct impact to these types of businesses. It is an indirect impact, though. So if you're selling widgets, your underlying customer is arguably taking longer to make decisions on purchasing those widgets from you. So you have a protraction of a sales cycle. So historically, what may have taken 4 to 6 months for that underlying customer to decide to buy those widgets for you may now take 6 to 9 months or more. So you have a protracted sales cycle, and when they're buying them from you, they may buy less. Or if they come back to buy more, they may buy less than what you thought. So you're going to see some compression on growth, and as a result of that, you're going to see higher burn rates. So companies need to get their cost structures aligned. They need to preserve cash and have very strong balance sheets to get through this market. The better companies that have all those ingredients and very strong offerings will be just fine. It'll take longer for them to get liquidity, but it'll be just fine. Companies that do not meet that criteria, they're going to have a hard time.
Christian Munafo, thank you.
It's a pleasure. Thanks for having us.
Thanks.